Welcome to our first quarter asset reviews. Today we are going through our commercial asset reviews. So we go through all the different asset classes and see how things are looking. Today, when we talk about commercial, what we mean is our medical, our government, and our general office properties. So we're going to touch base on what we're seeing in the market and then how those groups of properties are performing.
Right. And this is predominantly focused on our 2 to 4 story. I guess our tallest building is 6 stories. One, right in downtown Chattanooga. But most of them are 1 or 2 stories. Right. Park Lane is a medical deal. It's all 1 story. Parsons is 2-story medical deal. But these are not high rises. They're fairly low density. Lots of surface parking. Yeah. No parking. I guess we have 1 parking garage, but that's about it.
So when we look at the market as a whole, we're looking at how does this type of a commercial asset performing. The data, I mean, we try and get as much as we can. It's a little wishy-washy of what's out there, but we really break it down into kind of like the urban assets, the suburban assets, and then the higher multi-story assets. So those 3 general categories. And transaction-wise, this quarter was like, there was not anything that sold over 30,000 square feet.
Yeah, and in the suburban market, we looked at, 1 story, 2 story, and really anything outside the central business district of Atlanta, and not really nothing transacted. Most of it was owner occupied, so they're like $400,000 to $800,000 transactions. So nothing really in the investment world.
Yeah, it's kind of a crazy quarter of just nothingness,
right,
on that front. So it makes it every time we're looking at a deal, even a deal we own, we're always out there saying like, okay, what do the debt markets look like and what do the transaction markets look like? And we're using that to kind of make our decision on what are we going to be doing on an asset. If we see like, hey, these are selling really well in the transaction world, it's like, okay, how do we position it to make that so we can realize the best value on a deal?
Right. And a good example of that is our Midtown property is that we saw the biggest opportunity. It's 13 small buildings. So we bought it as a bigger property, 280,000 square foot, 13 buildings. But what we're finding is that to maximize our returns, we're better off selling them as individual buildings to either owner users or small investors that just want to build for their personal portfolio.
One at a time.
One at a time, they're buying 10,000 square foot buildings, give or take. So yes, we have 13 of them to go through. Some of them are a little bit bigger, but one at a time, we're finding the most success, and we have our 4th one under contract right now.
Yeah, to sell.
Right.
Yeah. So then, overall leasing velocity too. It was light on the transactions. We saw a lot of leasing activity. So right. we had over 40 leases that we were executing and working on in the first quarter that closed.
It was busy, and that's really indicative of the overall market. If you look at Atlanta, overall office vacancy is around 24%. But if you break that down and kind of get more granular with it, the urban core high-rise buildings, in Atlanta are closer to like 33, 34% vacant, when suburban office in Atlanta is more in the 8 to 10% range vacant. So we're seeing, and we're seeing that across our properties as well, is that for the most part, as long as the properties, as long as the units are renovated and ready to move in, we're signing leases immediately.
Yeah, it's been pretty good on that space. And we are seeing rental rates coming up. We look at our portfolio as a whole in the first quarter, our revenues were up. We didn't buy anything new, so the same footprint, and we didn't sell anything. So exact same footprint. Our overall revenues are up 12% in the first quarter over the fourth quarter of 24. So this is a pretty good jump. Most of that came from renewals. We had 25 renewals in the first quarter. We signed 12 new leases. And then we also had some increases from CAM. We go through our CAM reconciliations in the first quarter of every year, and we're taking what our 2024 numbers were compared to our 2024 CAM charges. Is there any true up that we have to go back and bill for? And then what does the new CAM charges look like going forwards? And again, that's our common area maintenance. So a lot of our commercial leases have where if taxes or if insurance goes up or if some maintenance costs go up, tenants will partake in those expenses and they have to reimburse us for them.
Yeah, so if we see taxes go up by 20% and we have full ability to push through with CAM, we're going to see a 20% revenue gain.
Over the next year.
We're over the next year, right? So we already paid that bill, so that it already hit our expense side. And then going forward, we'll see the 20% revenue gain, on a monthly basis over the next year.
So you mentioned occupancy, saying 8% in the suburban markets, but 30+% in the urban area, especially some of the higher buildings. We do get asked too, like, how is the Doge thing impacting any of our leases? And we're tracking all that. We're looking at their auction website of what they're trying to, I guess not really an auction, but what they're trying to offload, and leases that they are canceling. We haven't had any that have hit us, but we are seeing there's a few buildings in Atlanta. It's almost 3 million square feet of stuff that they're saying they're going to unload or they're going to sell. And I guess it's sort of vacant. It's all federal buildings that are in Atlanta.
Right. Yeah, I mean, we looked at, one of our government agency tenants looked at moving, and they put out an RFP, and they wanted to move to a certain part of town, but they had such stiff requirements of where they wanted to go and what they needed that basically required a new build, and that new build was going to be somewhere in the neighborhood of 300 plus a square foot. And there's no new office being constructed right now, even if there is a lease in place. So that just didn't get realized, so they ended up renewing with us.
So we go through our 3 types of assets. Okay, so we have our office, our government, and then our just general medical stuff, right? So we got those 3 types of assets. Our medical is right at 90% occupancy, right? So it's performing pretty well, and our vacancy there is really a building that was government, or it was state government. So it was our insurance agency that's up in North Carolina. Disappointingly, end of 24, they did not renew their lease there. So we signed a new lease with Bloomwell.
Mm-hmm.
So
an autism center.
Yeah, so we put a new tenant in there. They took 25% of the space, but are paying 50% of the equivalent rent as the tenant that was there. They're paying a lot more. We built that space out for them. We got to do some more leasing there, but we're considering that building, we got to convert it to medical.
Right.
So that's a little bit of the medical vacancy that we're seeing now, is that space moving from government to medical.
Right, and a lot of the medical demand is coming from the fact that, our office buildings have lots and lots of parking. So they can flex up when there's high patient demand, and then they just have a lot of space to access the buildings.
Our next part is our government overall stuff is 83% occupancy. And the majority of that is our Midtown deal. We consider a lot of the people there are our government, whether it's we have the IRS that's there, we have the city of Chattanooga,
big VA office, yeah.
So mostly government type user that's in there, and we do have vacancy that's there. And our West Park deal, we have 2 suites that are over there that are vacant as well. And that one's where we're trying to lease those. Those are pure office leases that are in that space. Things have been active, but we just haven't leased at those spaces.
Yeah, I think part of the story here too is that there is a good amount of vacancy on the market right now, and people are shopping and they're looking at a lot of different places and negotiating. And if you're a tenant right now, you have a lot of options. So that's slowing down your decision-making process. You're maybe putting out 2 or 3 different LOIs to different building owners to see how much TI, how much free rent you can get. That all takes time to get response rates. So we're just seeing everything kind of being a slow drag to get leased, to go through the process. I mean, even like Bloomwell, great tenant, we're excited to have them, but it was pretty close to a 9-month discussion with them to get to the point that we can start building their space out for them.
Yeah, in that one, the timeline there, we started talking with them in the end of the first quarter, beginning of the second quarter of 2024. And then as the state government tenant left, I guess they left in probably the third
I think it was August,
quarter.
Yeah.
And we immediately started the build out, got them in at the end of the year. It's a lengthy process. And that was they were ready to go and make a decision and eager to move forwards. And it still took, 9-10 months to go fully through that process.
Right.
So our next segment, our office or our general office, is 74% occupied. Some of that is a little bit of a purposeful on one end, not purposeful on the other. The Lupton is we've gone through lots of turmoil on this deal, and that one's been a challenge. We are actively leasing stuff, and we have 6 tenants that are in there now. So we're leasing space, and it's looking great. We'd like it to go 700 times faster.
Yeah, the property looks beautiful. It shows super well. We're getting lots of tours. Our rental rates are the lowest of the market, so we can get more occupied. But the tenants are coming in. They're great tenants. They're just not requiring a whole lot of space. So nobody's taking a full floor. They're mostly taking 1,000 to 2,000 square feet, and at that pace, we have give or take 50,000 square feet to lease here. So we have quite a few tenants to get in there. Yeah.
And then the other one that we mentioned is the station. Right. So the station, we do have a decent amount of vacancy that's over there, almost 25,000 square feet at this time frame. But on the exciting for me. We've been working with a local developer for almost a year now, going through what we can do at that site. So we're going to have some interesting conceptual ideas there that we think we'll be able to do. We knew when we bought that deal, back being in the QOZ, it's a great parcel. It's flat. Lots of access to 3 different surface roads. The city is going to be doing a roundabout development right in the front corner of that property. So we've got some options to redevelop that with a local developer, and we're not really signing any longer term leases there because of that. And then we'll have more information on that in the second quarter. But that one's moving along.
And we're also not looking to really put a whole lot of TI dollars in there because it doesn't make sense for you put the TI dollars in there for the longer term leases. This is not a longer term office play. This is a kind of a multi-plot redevelopment that we're working with the neighbors.
Yeah, this is scrape the whole thing down and build all sorts of stuff brand new.
Right.
If you've watched any of our stuff, you follow us. We're not developer builders, so we're bringing a partner that would do that part of it. But there would not be any office left on the site.
And what's exciting about our piece is we really have the access to the stoplight. So the
anything going back there behind us.
Yeah. So the bigger picture development, they need our parcel to really make the whole vision become a reality. So we're excited about working with them. They've been a great partner about putting it all together, and much more to come there. But
yeah. So that's our office vacancy is centered in those 2 tranches or those two assets. But a lot of our other stuff that is single and double story, 2-story stuff is leasing well, and we're filling up that space.
Yeah, Johnson Square is a great example, right? We're 97% occupied for 3-4 quarters in a row. We took that property from
68%,
68 to 90 in the high 90s, and it's been going great for us.
And the crossing center. Some of our deals we bought them. There's a crossing center developer here in Atlanta, so they built a bunch of deals named like Crossing Center 2, 3, 4, 5, 6. Not that our naming is that much more creative, but we didn't do that part. But our Crossing Center deal too is well occupied, making distributions and performing well as an office asset.
Right. So I think it's a good time to kind of take a second here and talk about the point in the market that we're in, and compared to kind of distribution. So if we're looking kind of our cash flows and the money that we have to put back into properties for TI, for improvements, et cetera, if you look at a property like Johnson Square, we bought it. We executed our renovation plan. We executed our lease-up plan. It was 97% occupied. It's completely ripe to sell, nowish.
Yeah, we did the business plan. The business plan was turn the whole thing around. Yeah.
And we're in the middle of a market that there's just no transactions. Transactions were down 80+% for really since its peak. And they continue to kind of trickle down further for really the 3rd year in a row. And so until transactions pick up, and the main thing driving the lack of transactions is lenders and debt. And without the lenders, without the debt, there's really no movement in the market. So we're sitting here looking at a Johnson Square property saying, man, this is a great time to sell it, but the market's not there for us. So we really need to hunker down and operate this thing, be in a good position to ride out the storm, maybe a year, maybe 3 years, and make sure we have ample reserves to do that. So a property like Johnson Square, even though it's 97% occupied, even though it has positive cash flow, made over $100,000 last quarter, but we're not distributing because we're stabilizing the balance sheet. We're making sure we have ample TIs for renewals and putting us in a good position to ride out the storm.
Yeah, and other deals like our some of our deals where we know we have a tenant renewal coming up. It's like, hey, we don't exactly know who's going to take that space, so we're being ultra cautious on reserving our cash to be able to pay for that. For example, some of our stuff, when we do move an asset from one category to another one, or if it's like, look, we can get a medical lease in there, we're going to be spending $100 a square foot in TI, which a lot of times we were not budgeting 100, or the prices weren't even 100 a square foot when we first bought these, even as an estimate.
Right, but it also wasn't part of the initial business plan was to change the tenancy. We do that. That just wasn't the plan with these assets.
It wasn't the plan to change the tenant type.
Right.
It's like, look, eventually maybe the tenant does change, but not like it's not going from a general office to a medical.
Right.
Medical is just completely different cost structure on deals. But they pay higher rent.
Mm-hmm. They have better credit when the transaction market opens back up. They sell at lower cap rates, so it's all positive to have, but it does cost quite a bit of money.
That's like when we can get one of the medical tenants, like this is excellent. Let's execute on this.
Right.
So, another part that impacts our deals, and it's as we look at things over a year, is like, what does the debt market look like? It is really tight right now, and rates are. I mean, the rates have come down a little bit from where they were called a year ago. So
Yep.
that part's positive. There's no free money anymore. So you're actually, you're paying 5.5%, 6+% on stuff. But we do have a couple loans that are coming up, not this quarter, but they're coming up throughout 2025. And that means we have to start working on them now. So anytime we have that happening, it's kind of like this inflection point in the deal where we want to line up what are our options to sell a deal, what are our options to refinance a deal, or it's more on the residential side. Some we were like, hey, can we just pay that loan off? What do we want to do there? So we're always going to put forwards like these are the options that we have on a deal when things are coming up. So we have a couple loans right now. Mostly we did a couple deals with a bank, FNB, and those are the ones that start coming up here in August and September. So the first one we have, one is Parsons, which even though the transaction volume is nil, we're like, look, we're gonna go put this one out and market it and see just see what's out there before we come up to that renewal. That renewal is in September, but we got to get started on it now. We need time to work on these things. The medical deal has vacancy where it could be great for an owner operator to buy it and then take that space. So that's what we're looking at. That's what we've been talking about with the brokers on that.
And your point about how long the transaction time takes, it's about a 6 to 9 week marketing process. And then if you do have a buyer, it's about a 2-month process to basically finalize pricing and get to a contract. And then from there, it's about a 70 to 80 day process for them to actually close. So add all that up, you're looking at like the better part of like 7-8 months.
Yeah.
From the time you start marketing it. So we're in market now, see what comes back, and then go from there.
Another one that's coming up is our Park Lane, right? So this is a strip center deal that we own that again ended up, it's mostly medical. It's right across the street from a hospital, so kind of dictates what's going to be there. But that loan is coming up from renewal, and again, these are in like the 3s, the interest rates on this, so they're pretty low. What we are looking at doing there is selling one of our out parcel sites, which is an orthopedics office.
Yeah, so it's 3 different. Yeah, it's 3 different parcels. This would be one of those 3 parcels.
Yeah. So that one, there's still retail transactions are happening, especially the net lease segment, especially when it's a smaller dollar amount, a couple $1 million, not 10.
Right.
So we're going to take that deal out and see what we can do there. That's really in preparation for what does it look like for this loan renewal as we go through that process. And the last one we have is our 1830, our Hillendale deal that's up in Raleigh area. So medical government deal that we have right now. As that loan comes up, we're going to go through what we can do there too.
Yeah, and all these will give us guidance. Looking at these 3, they'll give us guidance on how to apply to the rest of the assets and really help dictate really the next step of the strategy. But at the end of the day, in the background, we're stabilizing the properties to operate long term and to ride out the storm.
Yeah, we're not counting on any transaction. Like we're not counting on, hey, we can just sell something and take the gains from it right now. It's like this is probably not going to happen quickly.
Right.
So we look at, okay, when we have a deal, we're operating our distribution strategy. We've gone through our reserve plans on all of our deals. And in our quarterly reports, it outlines it very specifically deal by deal. And we'll also have our live Q&As that we always do too. Register for one of those. We can go through any of the deal and on all the specific points. But in general, what we're looking at is if we're below 85% occupancy on an asset, or we know we have a pending vacancy that we've got to handle. Those are the deals that we're not making distributions on. Then when you have a higher occupancy deal and we know we don't have any pending vacancies, that is a distribution. We have our Duke Medical deal, right? That's a deal where all the leases are a little bit different. Attorneys get involved, reword how they are. We inherited this lease, and it basically requires a tenant to give us notice that they're going to renew. But it doesn't require them to give notice if they plan to vacate. So we have this looming date coming out this summer of like what is going to happen. And since we don't have absolute certainty in one direction or another, it's like, hey, we feel like we should be conservative with the cash that we have, not make a distribution there, find out our answer, and then proceed. So that's the plan we're taking there. So that's a deal where we are full, but we have this pending unknown situation that we want to be very conservative in how we make our decision process around it. So that is our update on the commercial segment. Just in general, it's roughly a third in our portfolio on this, about a third medical, a third of the other two segments of the office stuff and of the government section. So we got a fairly even balance between what everything is. But we're also going to do our live Q&A at the end of the quarter here once our reports come out. And in that situation, we can hone in and dive into any of the deals specifically and go through exact lease terms and what things are looking like. And as always, reports will be out on the 20th. Distributions go out on the 20th. It's a Sunday this quarter, so
Easter Sunday.
Distributions will hit like Tuesday-ish time frame as we get all those out. And everything will be in your portal too to review. So, cool. Thanks for watching, everyone. Appreciate it.